We live in a world where the largest economic catastrophes are rarely caused by external enemies or unforeseen natural disasters. They are the calculated mechanical result of internal structural flaws, amplified by human psychology. Greed, leverage, and the collective delusion that this time is different. The year 2008 taught an entire generation this brutal lesson. September 2008. A 158-year-old investment bank collapsed overnight. $600 billion gone. Retirement accounts vanished. Millions lost jobs. What followed was the worst financial meltdown since the Great Depression. This crisis didn't just destroy wealth, it shattered trust, plunging the world into the Great Recession. This documentary provides a forensic, data-driven deconstruction of the 2008 financial crisis. We pull back the curtain on how cheap money, risky mortgages, and financial engineering turned the American dream into a global nightmare. We will dissect the crisis using the frameworks of the investigative documentaries that define the era, explaining the complex web of greed, policy, and market mechanics. We will prove that the collapse was not an accident, but the predictable endgame of a financial system that prioritized privatized profits and socialized losses. Understanding 2008 is not just history, it is survival. Because the system survived, but the underlying mechanisms that caused the crisis remain unscrutinized and unreformed, the foundation of the 2008 crisis lay in a seemingly harmless aspiration, home ownership. But by the early 2000s, the housing market was transformed into a machine fueled by risky credit and unsustainable growth. The crisis originated from the rapid expansion and subsequent failure of the United States housing market. This was primarily fueled by subprime loans. Subprime mortgages were high-interest loans extended to borrowers with low credit scores, people who historically would not qualify for home ownership. Lowering standards. The industry actively sought to increase loan volume by drastically lowering lending standards, disregarding the basic creditworthiness of borrowers. The entire mortgage system became built upon high-risk loans and pervasive misrepresentation. This was a foundation of lies and bad loans, the psychological shift. By 2005, buying a house wasn't about stability anymore. It was about flipping it like a pancake and hoping the next buyer paid double. Real estate wasn't shelter, it was a lottery ticket. This belief, the widespread delusion that housing always goes up, fueled the frenzy. The crisis was rooted in the fundamental paradox of modern finance: debt. Banks issued millions of risky mortgages, confident they could bundle and sell them as safe investments. Borrowers signed contracts they couldn't afford, often misled about the true costs. For a while, it looked like magic. Banks earned record profits, investors were thrilled, and home prices kept climbing. Debt, which should be a burden, was sold as freedom and became the ultimate financial product. The cost of illusion. This illusion of effortless wealth is a pattern that repeats throughout history. Every bubble, from tulips to tech stocks, starts with the same sentence. This time, it's different. It never is. The crisis of 2008 simply substituted housing for stocks bought on margin in 1929. The fatal mechanism of 2008 was financial engineering. Wall Street did not merely issue bad loans, it perfected the art of packaging those loans into instruments so complex and opaque that their true risk was impossible to discern. The high volume of poor quality, high-risk subprime loans served as the raw material for securitization. These loans were pooled and repackaged into securities called Mortgage-Backed Securities, MBS. An MBS is a package of thousands of loans bundled together. The next step was more intricate. These MBS packages were further bundled into complex instruments known as Collateralized Debt Obligations, CDOs. Risk obscuration. The purpose of this financial engineering was not innovation, it was fraud. It transformed toxic liabilities into seemingly safer investment products by mingling good debt with bad. The complexity itself obscured the underlying risks, the lie of the rating agencies. These packages often received fraudulent high safety ratings, typically AAA from credit agencies. This deliberate misrepresentation allowed institutions like pension funds and city governments, who were required to only buy safe assets, to unknowingly purchase concentrated poison. They thought they were buying AAA-rated securities, but they woke up to find they owned toxic waste. While the vast majority of the financial world believed in the illusion, a few skeptical investors recognized the inherent fraud and impending collapse. These investors, famously detailed in The Big Short, executed the Big Short, shorting the bubble. They used credit default swaps, CDS contracts, to bet against the housing market. A CDS is a derivative that functions as an insurance policy against the default of an underlying asset, like a CDO. These speculators paid premiums to the sellers, like the insurance giant AIG, and would collect billions if the CDOs failed. The magnitude of risk. By conducting intensive research that Wall Street professionals refused to do, these investors discovered that the system was built on fraudulent loans. Their success, making billions by capitalizing on widespread financial incompetence and negligence, demonstrated the immense structural danger of interconnected fragility. Localized failures in American mortgages had contaminated the entire global financial system. The crisis was not just a result of Wall Street greed. It was the product of decades of deregulation and structural failure within the institutions meant to protect the public. Investigative documentaries like Inside Job provided the definitive critique, detailing the historical changes in policy and the systemic corruption that permeated finance, politics, and academia. The systemic corruption. The film's central thesis was that the crisis was the direct result of the systemic corruption of the United States by the financial services industry. Institutional capture. A major finding was the deep structural compromise among the institutions meant to serve as checks and balances. Prominent academic economists provided intellectual cover for risky industry practices. Receiving substantial consulting fees from the financial institutions, they were theoretically supposed to analyze objectively. The exposure of these conflicts of interest was so significant that it compelled the American Economic Association to implement improved disclosure standards. The revolving door. Structural complicity was further reinforced by the political revolving door that placed former industry executives into key regulatory roles, ensuring that deregulation was often facilitated by intentional political negligence. The idea that the crisis resulted from a simple binary opposition between greedy Wall Street and naive Washington regulators is demonstrably false. Beyond the immediate financial mechanisms, the crisis was built on a deeper macroeconomic flaw: excessive income inequality, debt as sustenance. Increasing income disparity forced the majority of the population to rely on ever-increasing levels of debt, mortgages, credit cards, student loans, to maintain their quality of life. This created an artificial, unsustainable demand for the complex mortgage products that fueled the housing and credit bubble. The ancient warning. This structural reliance on debt is not new. Ancient kings declared jubilees to wipe out debts when too many people were crushed by loans, recognizing that a clean slate was necessary to keep society stable and rulers in power. They knew debt was the tool that binds ordinary people, and modern finance is no different. The global collapse began with the failure of one institution, amplified by a mechanism most people never understood. The narrative of crisis management often centers on the weekend preceding Monday, September 15th, 2008, when Lehman Brothers, one of America's oldest investment banks, collapsed. Lehman, heavily overexposed to toxic real estate assets, filed for the largest bankruptcy in history. The domino effect. The collapse sent instantaneous shockwaves through the global financial markets. The question was no longer who was next. It was, is the entire system broken? Markets crashed from London to Tokyo. The destruction of wealth. $19 trillion in household wealth was erased in the ensuing recession. The crash didn't just destroy wealth, it shattered trust. The illusion of control broke, and it revealed how the system works, and who it really works for. A critical analytical consensus is that the major cinematic narratives failed to adequately address the immediate mechanism of instantaneous failure: the run on the shadow banking system, specifically the repo market. Repo market function. Investment banks funded their massive leverage positions by issuing short-term, often overnight, debt secured by collateral through the repo, repurchase agreement, market. This non-deposit funding was the vital, volatile bloodstream of the investment banking system. The mechanism of panic. When the collateral, MBS CDOs, suddenly lost value, the repo lenders withdrew their funding en masse, refusing to renew the overnight loans. This illiquidity shock, rather than the cumulative dollar amount of foreclosures, was the immediate cause of the credit freeze and the systemic panic that nearly collapsed the system. Obfuscation of risk. The omission of this esoteric, yet systemically vital mechanism in mainstream narratives meant that the public discussion and subsequent regulatory focus shifted to more visible issues, such as foreclosure rates and executive bonuses. This obfuscation of the deeper structural vulnerabilities within the wholesale funding markets inadvertently benefited the financial industry, perpetuating systemic risk. Faced with a total economic collapse, the U.S. government had one impossible choice: let it all burn or throw billions of taxpayer dollars to the very guys who lit the match. In October 2008, the U.S. government picked the latter, securing $700 billion for the Troubled Asset Relief Program, TARP. The aim was to stabilize the financial system by injecting capital into failing banks. The film Too Big to Fail captures the desperate atmosphere and the high-stakes negotiations between Treasury Secretary Henry Paulson and Federal Reserve Chair Ben Bernanke to prevent total economic catastrophe. AIG's rescue. The rescue included massive support for the insurance giant AIG, whose failure, due to massive CDS exposure, would have amplified the collapse beyond recovery. The cost. A total of $626 billion was invested, loaned, or granted due to various bailout measures. As of January 2021, the Treasury had ultimately recorded a profit from the interest on the bailout loans. However, the human cost was staggering. Millions lost jobs, homes, and savings. The rescue cemented the principle that financial systems exist to protect themselves, not the ordinary citizen. Privatized profits, socialized losses. The core message of the post-crisis period was the confirmation of the moral hazard principle. Wall Street gambled with toxic mortgages, wrecked the global economy, and still walked away with trillions in bailouts. This was the ultimate demonstration of its core principle. Profits are privatized while losses are always socialized. The banks get rescued. The banks that caused the disaster were declared too big to fail and were rescued. This wasn't new. Governments always step in to rescue the financial system, not the citizens crushed under it. History proves it every time. The deepest scar left by the 2008 crisis was the profound lack of accountability for the individuals responsible for creating and selling the concentrated poison. The American public watched in rage as justice was completely absent. The unpunished elite, no major Wall Street CEO or senior executive from a too-big-to-fail institution, faced criminal prosecution for crisis-related activities, despite evidence of widespread negligence and corruption. The retirement of the rich. The people that ran most of the big institutions that got in trouble went away rich. They may have been disgraced to some degree, but they went away rich, proving that the incentive system had not been improved. The learned lesson. A generation grew up knowing that when the banks mess up, they get rescued. When you mess up, you get wrecked. The system survived, but trust burned to the ground. The lack of accountability persists because the laws are structurally designed to protect the institutions, not the public. Protecting banks from people. Banking laws sound like they exist to protect you, but in reality, they exist to protect the banks. After the 1929 crash, regulators promised strict rules, but the fine print always left loopholes. In 2008, those loopholes allowed toxic mortgages to be sold as safe investments. When the system collapsed, the laws made sure the system itself survived. Banking law is the shield of the system, not the saver. The next crisis. The financial industry, now more concentrated and less transparent, has evolved new tools for risk, leverage, and illusion. The illusion of stability, that someone else will clean up the mess, is the real bubble that hasn't popped. The 2008 crisis confirms that the structural mistakes of finance repeat across centuries, proving that history provides the blueprint for survival. The crisis proves that human psychology, greed, panic, and the search for effortless wealth is the permanent variable. The bubble cycle. Every bubble promises easy wealth, and every crash punishes those who believe it. The collapse of 2008 was the echo of the 1929 crash. In the Roaring '20s, people bought shares on margin, borrowing 90% of the cost. When confidence cracked in October 1929, panic selling forced liquidations, wiping out ordinary families. The madness of crowds that drove the South Sea bubble in 1720 still drives housing frenzies and cryptomanias today. The scammer's blueprint, the subprime scam, where complicated financial tools were used to make worthless paper look safe, mirrors the Ponzi scheme. Ponzi paid old investors with new money, creating the illusion of profits. Today, the scam never died. It just changes names. The illusion of guaranteed returns keeps coming back because people want to believe in shortcuts. The crash was an enormous wealth transfer. Crises don't destroy wealth, they transfer it. The crisis profit. While millions suffered, a small group of billionaires quietly made more money than ever before. They had liquidity, they waited, and they bought everything cheap when the dust settled. They bought companies, land, and industries for pennies. This is the paradox of crisis. When value disappears, power concentrates. The modern trap. The system is designed to reward proximity. The closer you are to the source of new credit and liquidity, the more you gain. Financial repression, keeping rates low, pushes savers into becoming forced speculators while the state and its financial allies quietly fund themselves on the back of devalued labor. The families who survived hyperinflation and collapse, from Weimar Germany to modern Lebanon, didn't rely on paper promises or government guarantees. Real assets. They survived with real assets. Land that still produced food. Useful skills that generated value, gold, silver, and networks of trust. Real wealth is what survives when money fails. Financial discipline. Financial freedom isn't having more. It's needing less and staying in control when fortune turns. The Stoic mindset, which teaches detachment from outcomes and mastery over desire, is the only financial armor that never fails in a crisis. The 2008 financial crisis was the result of a catastrophic alignment of regulatory failure, financial innovation, and pervasive corruption. It confirmed that unfettered, highly leveraged finance, insulated by institutional corruption, possesses inherent self-destructive tendencies. The essential lesson is that you cannot outsource your safety to the system's promises. History is clear. Financial education is not optional. You must build wealth that is not based on paper claims or market hype, but on real, durable value. The next crisis will come. It will look harmless, profitable, and inevitable until it isn't. History doesn't repeat, but if you don't understand the pattern, it will crush you all the same. The question is whether you will be the victim of the next collapse, or one of the survivors who use knowledge as a shield.